Hey class, welcome to chapter 23. We're going to talk about relevant costs for managerial decisions. Okay, first let's describe the use of relevant costs and the benefits for short-term decisions. Managerial decision making has 5 steps. First, define the decision, then identify alternatives. Next, collect relevant information and evaluate the alternatives. Select the course of action after that, and then finally analyze and assess decisions made. These 5 steps are shown here on Exhibit 23.1. Managers use financial information such as expected revenues and costs for decision making. Non-financial information is also important and includes things like environmental and social data. So anytime that management is doing some kind of analysis, like for example, the budget to actual analysis we've talked about in previous chapters, they must be able to distinguish between relevant and irrelevant costs and benefits. So relevant costs and benefits must always be considered in managerial decisions. Irrelevant costs and benefits must be ignored for purposes of managerial decisions. Relevant costs and benefits are future-oriented, they're tied to cash flows, and or they focus on incremental effects across alternative managerial decisions. So this kind of gets into our what-if analysis. So those incremental costs or those incremental effects are also called differential or avoidable. They're important to identify so that management can make good decisions. So the incremental revenues are additional revenues generated by selecting a certain course of action over another. Incremental costs, also known as differential costs, are the additional costs incurred if a company pursues a certain course of action over another. Incremental income is just the incremental revenues minus the incremental costs. A good rule of thumb is to always choose the alternative that most increases incremental income. Kind of goes back to what we were saying with our unfavorable and favorable variances in a previous chapter. Always think logically about what is going to increase income. An increase in revenue increases income. A decrease in cost increases income. 4 types of costs are important when distinguishing relevant costs, including sunk costs, which arise from a past decision and cannot be avoided or changed. It is irrelevant to current and future decisions. An example is the $1,000 we previously paid for a smartphone. That sunk cost is not relevant to a decision to replace it if it breaks. We've already spent it, we can't do anything about it now. Likewise, depreciation of the original cost of an asset is a sunk cost. Most of a company's allocated costs, including fixed overhead, are sunk costs. Out-of-pocket cost requires a future outlay of cash and is relevant for decisions. For instance, the cost of a future phone purchase is relevant to the decision of whether to replace a phone. Opportunity cost is the potential benefit lost by taking a specific action instead of alternative actions. They're relevant to many managerial decisions. This is one you hear a lot. An example is a student giving up wages from a job to attend summer school. The lost wages are part of the cost of attending summer school. Although opportunity costs are not entered in accounting records, they are relevant to many managerial decisions. Avoidable cost is a cost that can be eliminated by choosing one alternative versus another. An avoidable cost is always relevant. An example is an employee's salary that is avoidable if their work is automated, for example. We'll now talk about make or buy decisions. So let's look at Fast Track's make or buy analysis for one of their key parts. It costs them $1.20 in order to buy the part right now. In order to make the part, the direct materials and direct labor are 35 cents and 50 cents respectively. But then you'll notice we have an overhead amount of 20 cents per part, which is an incremental cost only. So, a lot of times the fixed costs or the fixed overhead might be the same, or you might have the same types of costs, right? Whether you make something or buy something. This overhead represents the additional 20 cents that it would be to make the product. But still, even after you add up the direct materials, the direct labor, and the incremental overhead, it still comes out to be less expensive to make the part. So it's $1.05 to make the part, and it's $1.20 to buy the part. So obviously the decision in this case is to make the part in order to save the 15 cents per unit. Now we'll move on to evaluating sell or process decisions. Many companies must decide whether to sell partially completed products as is or to process them further into other products. For example, a peanut grower could sell its peanut harvest as is, or it could process peanuts further into other products such as peanut butter, peanut oil, and peanut lotion. This decision depends on the incremental costs and revenues of processing it further. To illustrate, suppose that a company has spent $30,000 to harvest peanuts. The company can sell the peanuts to another manufacturer as raw material for $50,000. Alternatively, it can process them further and produce a nutritional supplement. Processing them further costs an additional $80,000 and will result in revenues of $150,000. So the company must decide whether selling as is or processing further produces the higher income. On this slide, Exhibit 23.3 shows the sell or process analysis. So the income of $70,000 from the processing further is greater than the income of $50,000 from selling as is. The company should process further and earn $20,000 of incremental income. That's the $70,000 minus the $50,000. The $30,000 of previously incurred harvesting costs are excluded from the analysis. And that's because, remember, those are sunk costs, so therefore they're not relevant to the decision. We've already spent it, we can't change it now. The decision rule here is select the action with the higher income, so they will process further and earn that additional $20,000 incremental income. So now a variation of this sell or process decision is called the scrap or rework decision. Manufacturing processes sometimes yield defective products. Managers must decide at that point whether or not to scrap the work or rework the products. So let's assume that Fast Track has 1,000 defective units of a product that they've already spent $10,000 to manufacture. These units can be sold as scrap for $4,000, or they can be reworked for $8,000 and then sold for $15,000. So, should Fast Track sell the units as is, as scrap, or should they rework them? Well, the $10,000 manufacturing cost is already incurred, so remember what that is? A sunk cost. It's irrelevant. The $4,000 revenue is scrap, is the opportunity cost of reworking, so therefore it is relevant. Analysis is in this exhibit shown here on this slide 23.4. Fast Track should rework the units and they would obtain $3,000 of incremental income. So see, that's the $7,000 minus the $4,000 if they would have scrapped it. So that's a $3,000 incremental income if they rework it. Now we'll learn how to determine the sales mix with constrained resources. So now think about in the real world when a company sells a variety of products. Well, if its production facilities are constrained, management will look for the most profitable sales mix. Management focuses on the contribution margin per unit of scarce resources. To illustrate, let's look at a company that makes two models of scooters with selling prices and variable costs shown here in Exhibit 23.5. The same machines are used to produce both models. The company has a capacity of 2,000 machine hours per year. Pro model uses 1 machine hour per unit, while Max model uses 2 machine hours per unit. The company should produce the model that yields the highest contribution margin per machine hour until market demand is satisfied. Exhibit 23.5 shows the contribution margin per machine hour for both models. The Pro model has a higher contribution margin of $150 per machine hour. The company should produce as many units of Pro as possible up into the market demand. So what if there's unlimited demand? If the market will buy all that the company can produce, the company should devote all 2,000 machine hours to production of the Pro model. That's 2,000 machine hours divided by 1 machine hour per unit, that's 2,000 units of Pro. And none to the Max model. This sales mix would yield a contribution margin of $300,000 per year, the maximum the company could make under the existing capacity of 2,000 machine hours per year. This is shown in Exhibit 23.6 here on this slide. So what if there's limited demand? If demand for the Pro model is limited to 1,200 units, for example, the company will first produce the 1,200 units of Pro, using the 1,200 machine hours required to make them. This leaves 800 machine hours to produce the Max model. 800 machine hours results in 400 Max scooters. As you remember, Max requires 2 machine hours to make. This sales mix yields a $220,000 contribution margin, as we see here in 23.7. So the decision rule here is, if the product demand is limited, produce the product with the highest contribution margin per unit of scarce resource all the way up to its total demand. Do that first. Then use the remaining capacity to produce the product with the next highest contribution margin per unit of scarce resource. Let's now look at segment elimination decisions. When a segment of a business is performing poorly, management must consider eliminating it. Segments with contribution margin less than avoidable fixed costs are candidates for elimination. Remember, avoidable costs are eliminated when the segment is eliminated. They include all variable costs and direct fixed costs, such as rent on that segment's space and insurance on that segment's eliminated equipment. Unavoidable costs remain even if the segment is eliminated. These costs are allocated to remaining segments when a segment is eliminated. So Fast Track reports results for its 3 segments in Exhibit 23.8. Total income is $95,000. However, its treadmill segment shows a $10,000 loss. Management is considering eliminating its treadmill segment. We must be careful, however, as some segment costs might be unavoidable even after we eliminate the segment. So the decision rule for this type of situation is that a segment should be eliminated if the income increases from the elimination. However, we should let the segment continue if income decreases from the elimination. Eliminating the treadmill division would eliminate its sales, variable costs, and contribution margin. So its $15,000 in fixed costs consists of $4,000 in avoidable costs and $11,000 in unavoidable costs. The $11,000 in unavoidable costs would be reallocated to the wellness, $8,000, and the fitness, $3,000. Revised results are included here in Exhibit 23.9. We see that if the treadmill segment is eliminated, then total income actually decreases by $1,000 from $95,000 to $94,000. This means the treadmill segment should continue. We're not going to get rid of it. The same decision is made using the segment elimination analysis in Exhibit 23.10. The continue column shows treadmill results for the current period. The eliminate column shows what items remain after the segment is eliminated. We see $0 for sales, variable costs, and contribution margin. Those all go away if the segment is eliminated. The eliminate column does still show $11,000 of fixed costs that are unavoidable even if the segment is eliminated. So the income increase or decrease column shows that $1,000 decrease in income if the segment is eliminated. This indicates that the segment should not be eliminated and is the same result from comparing Exhibit 23.8 to 23.9. So no matter which way you look at it, we're still coming to the same result. The decision rule here is that a segment should be eliminated if income increases from elimination. It should continue if income decreases from elimination. Now let's look at keep or replace decisions. Managers periodically must decide whether to keep using a plant asset such as equipment, or maybe they should replace it. Advances in technology typically mean newer equipment can operate more efficiently and at a lower cost. The keep or replace analysis compares the revenues and costs of keeping the old asset versus replacing it with a new asset. Relevant revenues and costs include any change in variable manufacturing costs with the new asset and the net cost of the new asset, computed as the purchase price minus any trade-in allowances or cash received from the sale of the old asset. So the decision rule here is replace an asset if income increases, but keep the asset if income decreases from the replacement. To illustrate, Fast Track is considering replacing an existing machine with a new machine. The keep or replace analysis is here in Exhibit 2311. We should keep the existing machine because the new machine will decrease overall income by $5,000. The $20,000 book value of the old machine is not relevant because it's a sunk cost and cannot be changed. The decision rule here is keep the current machine. Now let's look at determining the product selling price. Pricing decisions are one of the more important decisions that managers make. It's also one of the most difficult decisions. Managers must take concepts involving supply and demand and apply that to its product or service pricing. For that purpose, it is important for managers to understand the setting in which they set prices. Companies can be price takers or price setters, or anywhere in between these extremes. It's kind of like a spectrum. The graphic below reflects this range and the characteristics of companies at the extremes. Price takers have less control over setting prices, whereas price setters have more control. Price takers use more target pricing type methods, whereas price setters use more cost plus pricing. Most companies lie somewhere in between these extremes. We describe three normal pricing methods. Cost plus methods are common when companies are price setters. Management adds a markup to cost. That's how they get to their selling price. So your selling price per unit is the cost per unit plus the markup per unit. The total cost method, or cost plus pricing, is a three-step process. First, determine total cost per unit. This is the product costs plus selling and administrative costs. Total cost divided by total units expected to be produced and sold. Second, determine the dollar markup per unit. Total cost per unit times the markup percentage. Third, determine selling price per unit, and that's just the total cost per unit plus the markup per unit that you determine. So to illustrate, a company produces headphones and it targets a 20% markup on total cost. It expects to produce and sell 10,000 headphones. The following additional information is available. We apply the three-step total cost method to determine selling price per unit. So step 1, total cost per unit. Add product costs, your direct materials, your direct labor, variable overhead, and fixed overhead, to the selling, general, and administrative costs. And that gives you your total cost. Then you divide that by the units to be produced and sold to give you your per unit cost. And that works out to be $70 in this example. So step 2, you determine your markup per unit. The total cost per unit of $70 times 20% markup percentage gives you $14. Step 3, the selling price per unit. That's your total cost per unit, that's $70, plus the $14 markup gives you $84. That's your selling price per unit. When competition is high, companies might be price takers and have little control in setting prices. In such cases, target costing or target pricing can be useful. The target cost equals your expected selling price minus your target profit. If the target cost is too high, lean techniques can be used to determine whether the cost can be reduced enough that the target profit can be made. For example, if the expected selling price for headphones is $80 each and the company wants to make a profit of $14 per unit, it must find a way to reduce its target cost per unit to $66. That's the $80 price minus the $14 target profit. So this is basically just like an algebra equation where you're trying to solve, this is the profit we need, so solve for X, that's the target cost. What do we got to get our costs down to in order to meet that target profit? So let's look at the variable cost method. This determines the price by adding a markup to variable costs. The markup is set to cover your fixed costs plus your target profit on top of the variable cost. So 3 steps are needed here. First, determine your markup percentage. That is your target profit plus your total fixed costs divided by your total variable cost. Second, determine the dollar markup per unit. That's your variable cost per unit times the markup percentage that you just calculated. Third is determine the selling price per unit. Now that's your variable cost per unit plus the markup per unit. To illustrate, we draw on the variable and fixed cost data for those 10,000 headphones from the previous total cost example. Our target profit is $140,000. At a selling price of $84 per unit, income equals the contribution margin, 10,000 units times $34 markup per unit, minus $200,000 fixed costs, which gives you the $140,000. Let's look at special offer decisions now. Sometimes companies will receive special offers at prices lower than their normal selling prices. We evaluate these special offers by computing their income effects. Remember, it all comes back to how does it affect income. To illustrate, Fast Track produces and sells 100,000 units annually. Its per unit and annual sales and costs are in the contribution margin income statement in this exhibit. Its normal selling price is $10 per unit, and each unit sold generates $2 per unit of income. The decision rule here is accept the special offer if income increases, and obviously we're going to reject it if income decreases. Now let's say we have a new customer who wants to buy 10,000 units at $8.50 each and export them to another country. The offer price is below the normal price of $10 per unit, but this sale would be several times larger than any single previous sale, and it would use up the idle capacity that we have. So because the units will be exported, this new business will not affect current sales. We focus on incremental costs to determine whether accepting the offer will increase income. The historical cost per unit is not necessarily the cost of this special order. The variable manufacturing cost to produce this order will be the same as for its normal business, $3.50 per unit for direct materials, $2.20 per unit for direct labor, and 90 cents per unit for variable overhead. Now, fixed overhead costs, again, will not change regardless of whether this order is accepted. The fixed overhead costs of 60 cents per unit on a normal business are not relevant to this decision. This order will incur incremental fixed general and administrative costs of $1,000. So given all that information, we prepare a contribution margin income statement covering specifically this special offer. This exhibit shows that accepting this special offer results in $18,000 of additional income. That's all for this chapter. Thanks and good luck.